Hey folks, Ross here. Today we're going to talk about the new tax plan. And if you remember, there was a time when Trump was talking about the new tax plan, you'd be able to do it on a postcard. Well, that didn't happen in this tax plan, but they did make some changes. So in the past, we had 7 tax brackets. Now we have 7 tax brackets. That didn't make life easier, did it? But they're at least lower in 6 of the 7 cases. So we went from brackets of 10, 15, 25, 28, 33, 35, and 39.6 to now the proposal is 10, 12, 22, 24, 32, 35, and the top marginal rate of 37%. I mainly deal with medical providers, and as I'm sure the rest of you know, those people tend to be towards the higher end of this tax bracket. So I'm going to go through an example of what it may look like if you were, say, an oral surgeon, a plastic surgeon, an orthodontist, someone that's got, around $700,000, maybe even $1 million worth of income. So let's start there and let's go through an example of what it would look like if you had $1 million in income under the old tax rules for 2018 and the new proposed rules for 2018. For this person, if they were to use the old rules going forward into 2018, so if there aren't any changes, $1 million in income is in that 39.6% bracket, so they would expect, or they would have expected to pay a little bit more than $340,000 in taxes. Under the new proposal, a person with $1 million in taxable income would expect to also be in the top marginal rate, which at this time, under this proposal, would be 37%. So they're obviously going to benefit. Rather than paying the $340,000 in taxes under that 39.6%, our old system, they're going to be looking at $309,000 in taxes. So they're going to pick up about $31,000 in tax benefits. The idea behind having a tax break is to spur economic activity. So these people would have an extra $30,000, $31,000 in income to them that they didn't hand over to the government. And so now the question is that enough to hire, say, a full-time assistant? Probably not a full-time person, but maybe half-time. You could increase some hours for your staff. Could you go out and purchase some new stuff with this extra money? Sure. Make a nice down payment on, say, an iCat, cone beam. You could probably get a digital Pan-X if you wanted one, or you could upgrade your computer systems. So the money could come in handy and it could be used for your business. You could also probably stash some of that into retirement accounts, which would theoretically fuel the stock market. Or you could go out and spend it on fun things, which would theoretically spur the economy. So it seems to me like a person in this tax bracket is going to have a little bit more disposable income and they have more options. So as far as what the tax plan is trying to do at the top end, it seems to me like there's going to be a benefit and that person should be able to use that. So there are other parts of the tax plan, other changes that happen besides just those tax brackets. They doubled the estate tax or the death tax kind of floor, if you will. So the way that it used to work was you get taxed all of your life, and then when you die, they wanted to take another, half of it, basically, because they could. And so they limited that to people with under $5.49 million worth of value or worth of assets when they died. Well, they've doubled that now, so that makes it 10.98 million is that threshold. If you have more than that, you're still going to be stuck with the death tax. Sorry, but it's going to be a lot less of a burden for your family. The standard deduction is going to go up, so it's going for a married family from $12,700 all the way up to $24,000. However, the downside to this is they're taking away the personal exemptions. The change in the standard deduction isn't going to outweigh the offsetting loss if you have 3 or more people in your family to the standard deduction. So you're not really going to be thrilled with that part of the change. So coastal and blue states that tend to have really high state income tax levels, you're going to find that the deduction on that has been capped at $10,000. So people in those coastal areas who pay a lot more than that in state taxes used to get some kind of benefit that was really shared with the rest of the country who had lower taxes. Well, that's being capped. It's not necessarily going away completely, but people in the coastal states aren't going to be very happy with it. How about the child tax credit? They have doubled that. That was something that Rubio was really fighting for, making sure that there was more room and that a lot of that or more of that was going to be refundable for people that really aren't paying taxes. So there was a big win there for people on the lower end of the scale. They've also put a cap on the home mortgage deduction. So it was at $1 million and now it's down to $750,000. So what this is going to do is you'll probably see a slight drop in the value of houses that are in that $1.2 million to roughly $900,000 area, because those people have been benefiting from taking a deduction and itemizing that mortgage interest all the way up to $1 million. Now at $750,000, there's not going to be that benefit in between. So those houses will probably come down a little bit in value. Okay, here's the thing that goes completely contrary to the whole idea that we could do our taxes on a postcard. The alternative minimum tax, they raised the bar a little bit, they raised the threshold a little bit, but they didn't get rid of it. So if you're in that situation, or if you even think you might be close to that situation, you have to do your taxes twice, which is ridiculous. This is one of those things that really needs to go. It's too bad they're not giving up on it, but the reason why they want to keep it around is they just feel like there are some people who have the ability to itemize enough deductions that they end up paying a really low proportion of their income to the government. And so from the government's perspective, from the fairness perspective, somebody in that situation also uses the same roads that we use. They use the same parks that we use. They use the same police officers and fire stations and bombs that we drop on foreign countries. They're using that stuff just as much as the rest of us are. So I kind of see why the AMT exists, but it certainly didn't make things any easier. You can't fill this out on a postcard. So the penalty for not having health care, one of the individual mandates that they had in Obamacare, is now gone. Certainly a good thing. It means that healthy people aren't going to be forced to cover sick people. And the real issue with Obamacare is one that nobody talks about. And basically, think about, it wasn't insurance, okay? And what I mean by that is, for me personally, my family's deductibles tripled as we had to take Obamacare because, self-employed. Our premiums quadrupled, so that wasn't very fun. So it turned out that we had to spend about $30,000 a year before the first dollar of benefits really kicked in. So we weren't using our insurance, but of course it was, kind of helping us. Like, my fear is on the catastrophic event, right? If someone had cancer or a broken arm or something, sure, we would have been covered after we spent the first $30,000. They've decided to take that away. You no longer are forced to buy that, which is wonderful. There already was a little loophole, and it's something that I had switched to, and we'll cover it on another day, but I switched over to a Christian health sharing plan, right? It was exempt from Obamacare, and like I say, I can talk about that, but you still have those options. I guess you could still, if you wanted to, as a self-employed person, you could still support all the other people that get subsidies through Obamacare and pay through the nose. You could choose to go alone and kind of self-insure, just put money in the bank, and if you're going to use it when you get sick, that's called self-insurance. You could still join one of these faith-based kind of cost-sharing plans. But the real issue behind the flaw in Obamacare was simply the way that insurance works. So I used to work at an insurance company, and I know that if someone called me up and told me that they had a pre-existing condition on their house, and that pre-existing condition was that it's on fire, I wouldn't cover that house. We're sorry, but we're not going to take that risk that, your house is on fire and we're not going to insure you at $1,000 a year. But that's what they did with Obamacare. You could have pre-existing conditions, you don't have to pay for it, you could have cancer, your left arm just fell off and the rest of us had to pay for it. Okay, that was a problem. So healthy people are no longer going to be forced into Obamacare. So they didn't get rid of Obamacare, but they made enough changes so folks don't have to use it. And then the next big thing they did is that they cut corporate taxes from 35 to 21%, which means that we can now compete globally with, let's say, China, that have lower tax rates than us. So you're probably going to see a few companies start to invest more in the United States and less abroad because of this change. However, what this did is it forced a little wrinkle in the way that they were writing the law. So if I have, say, a C corporation, like I'm Microsoft, my tax rate went from 35 to 21%. What about people with an S corporation? What about people with LLCs? And what about people, say, in partnerships? What did it change for them? Well, for those people, they really made some complications when they put together this rule. So these entities are what we call pass-through entities. And the way that it works is you could take your profits in the business you would write it on your 1120S, and then it's going to flow through down to your personal 1040. It's going to show up as your business income or loss. So your corporation or your LLC didn't have to write a check to the IRS, okay? So it passed through down to you. So now what they're going to do with pass-through entities is that they are going to lower the taxable rate down to 20%, unless you're a service business. That is, unless you're a service business that has less than $315,000 in income if you're married. Are you confused? I'm confused. And if I'm confused, you'd better be confused. Do you see any potential loopholes or games that people are going to start playing, knowing now that some of your income is at 20% and some of your income is going to be at your taxable, your marginal income tax rate? I do. So what this is going to come down to is the definition of how you were splitting up your income. How much of your income are you going to assign as W-2 income, and how much of your income are you going to assign as profits from the business? And more importantly, if you're a passive owner of your business, you're going to get 20% tax rate. But if you're working for your business, well, now you're talking about paying that higher marginal rate on your W-2 earnings and then getting a small portion of it possibly taxed at 20% as far as the profits of your practice go. So the IRS kind of has a smell test about how you split up between your W-2 and your profits, right? So let's imagine that you're a general dentist and you decide that with your $400,000 in income, you're going to call $50,000 of it your W-2 wage, and you're going to call the other $350,000 your profit. So the IRS is going to notice that, flag that, be mad at you, sit you down at the table and ask you the following question. So would you come and work at the IRS, 32 hours a week and do all of our dentistry if we pay you $50,000 a year? As a dentist, they got you. You're not going to do that. You command more than $50,000 on the open market just to do your clinical work. So what you really need to do is you really need to allocate your profits between what you would pay yourself if you were an associate in your own practice, and then the profits of the practice would be kind of left over from that. To further complicate things, you still have to balance your desire to max out your Social Security earnings so that you're going to get the maximum benefit. And you have to figure out how much money you want to put into your IRAs, your SEP IRAs, your 401ks, your deferred benefit plans, all that kind of stuff, right? So you got to balance that when you're also deciding how much of my W-2 wage should I take versus how much should I call profits. Now, I mentioned earlier that if you were a passive owner in this business, you're going to be able to get taxed at that 20% level, which is great, right? So how many people are we going to see that are going to start transferring their businesses to their kids, their family members, their cousins, their uncles, maybe even trading businesses back and forth so that you could be a passive owner in the business over there and then take a W-2 wage in the business here? Now, I haven't thought through that strategy, but I'm sure there's somebody out there that's much more intelligent than I am that's figured out, hey, this is what we're going to do. We're going to start swapping companies so that I can be a passive owner in business B and I can work at business A, and somebody else can be a passive owner in business A and work at business B. Ridiculous as that may sound, I think this is going to happen, and I think as an appraiser, I'm going to find my way into a lot of business helping people buy and sell their businesses in complete sham ways that are going to be perfectly valid through this new tax system. We'll see. So the big question I'm still going to leave you with is, will all of these changes actually have an impact on economic growth? Because that's really the plan. We're going to cut taxes so that we can grow our economy. So go ahead, feel free in the comments section to give me your guess and give me your dreams of how you are going to find a way to exploit some of these potential loopholes that they've written into or they're going to write into the law that perhaps they didn't think that they were creating. Other than that, thank you very much for watching. Enjoy your weekend.